Hi. We're back with a microphone borrowed from my friend Mike. So if it looks high tech, well, it's a lot more high tech than anything else we have. So hopefully the sound quality is pretty good. We wanted to take a minute to fill you all in on how we did the line of credit on our house to purchase this duplex, because it was kind of a different way of doing things. Because originally with the Wilson deal, we were trying to do a conventional mortgage, but we had some trouble because the Wilson deal, it was two different properties we were trying to buy. And one of the properties actually had two houses on the same lot. And they weren't attached. So it was like two separate single-family homes on the same lot. And trying to get a mortgage for that ended up being impossible. I checked with 3 different banks, and all 3 of them said, "I'm sorry, we can't give you a loan for this property unless the houses are on different lots, and then we'd give you, separate loans for each house." I guess they figured if something went upside down and they couldn't, we couldn't repay the loan, they would have a tough time selling 2 houses on the same lot, which makes sense. I mean, the folks we were considering buying from were having trouble selling it too. So in that situation, it would have been nice to have this line of credit already established, because essentially we would have been making a cash purchase and we wouldn't have had to involve the banks at all. But at that point, I hadn't even thought about the option of doing a line of credit. And it was after that we talked with another bank, and they suggested that as an option that might have worked if the properties hadn't had termites. Maybe we could have revisited the deal and gone in that direction. But so while we continued looking for other properties after the Wilson deal fell through, I went ahead and opened the line of credit against our current home. And I was a little nervous at first thinking about doing it, because essentially we were taking out another mortgage on the house. We have a lot of equity in the house, which is nice, because early on when I bought the house in 2007, I made a lot of extra payments on the principal, and so we ended up with a lot of equity in the house, because back at that point I was kind of a diehard Dave Ramsey kind of guy, and no debt is good, pay down your debt as quickly as possible. So I was paying down the home mortgage really fast, and that did end up being a good thing, because we were able to take advantage of all that equity and take out this line of credit. So the amount that we took out was about half of the equity left in the house, and that was more than enough to purchase the duplex. But I don't know, how did you feel about essentially remortgaging our house?
I was fine with it, since the idea was that we'd be getting rent to cover paying for it. So
yeah, it seemed like good debt.
Yes.
And not bad debt.
Mm-hmm.
Bad debt would be like buying an insanely expensive car, like we're thinking of doing, and making ridiculous payments on it, because it's not an asset, it's a liability, and it's going down in value. Whereas this duplex in Franklinton is an asset, and it should go up in value over time. Slowly. It'll probably go up very slowly, because it is an older house, and it's kind of out in the country more. It's in Franklinton. It's in the town of Franklinton, but Franklinton is a smaller town, so I don't imagine the property values will rise as rapidly as they have been rising here in Wake Forest lately. Mm-hmm. But regardless, it's debt on an asset, so hopefully it will generate income for us each month instead of taking income away. But anyway, yeah, back to the line of credit. So actually applying for it through the bank was pretty easy. It was, there was some paperwork to fill out, and I had to provide some documentation, like 2 months worth of pay stubs and a balance sheet for my LLC and all that kind of thing. nothing too onerous, and it actually ended up being simpler to open than the original mortgage on the house was. So that was nice. And at that point, the line of credit was available through a regular checking account. So we could just write checks, basically overdraw the account to access the line of credit. So when it came time to go purchase this duplex, we just went to one of the bank branches and said, hey, we need a bank check for this amount against this line of credit. And they printed it up and handed it to us. So it was pretty easy. And then as we shared in our other video about closing on the duplex, it was just a single document that we had to sign because it was considered a cash purchase because, the check was drawn on the line of credit and it was as good as cash. So it made things really, really easy and simple. And what was nice too is we were able to roll some of the settlement costs into that line of credit too. So basically we were able to get into the duplex with no money out of our pocket. It all came out of the line of credit. So essentially any return on investment we get is infinite at this point, since we haven't actually fixed anything up. So it seemed like a good way to go. And I'm still able to sleep at night. Are you able to sleep at night? I guess the worst case scenario is the duplex doesn't make money, the tenants move out, and we're stuck making those payments. But I guess I felt better going into it because, like we discussed before, we already have enough in savings where we could have paid cash for the duplex if we had wanted to. So this way we're using the line of credit instead. We're using that leverage, but we still have in savings enough money to completely pay off the line of credit if we had to, if there was an emergency or something. And because I would be uncomfortable putting our primary residence up as collateral against this, our first experiment in real estate. If we didn't have that kind of backup. So maybe down the road when we get used to doing this and we have more experience, we can do this again, maybe with a larger amount and not have as much in case of emergency, just because we'll be relying on experience to lower the risk. Right now we have so little experience, I feel like the risk is higher than it should be, so we want to try to mitigate the risk in other areas. But yeah, that's about it. What I'm hoping we can do is, once we get this duplex fixed up, and assuming it's generating a good amount of revenue each month, we can fix it up enough to kind of force some more equity into it, and then we can turn around and do a conventional mortgage on the property. Do like a cash out refinance and then pay off our line of credit, and then we'll just have a fixed rate 30-year mortgage on the duplex that we can be paying off each month, and then we have the full amount in our line of credit back, and we can go shopping for another property or use part of that line of credit to build on the property like we've been talking about. Because there's two mobile homes on the back of the property, and they're kind of falling apart, and we don't really want to fix them up, and mobile homes aren't allowed in Franklinton anymore, so we're thinking we'll just get rid of those and possibly build one or two more duplexes on the property. So maybe we'll talk about that in the next video. And until then, anything to add?
I don't think so.
All right, check out lines of credit. It's cool. Just don't use it for stupid stuff like insanely expensive cars
or a yacht.